Hello, friends, and welcome to the Optimized Advisor Podcast, where we focus on optimizing the well-being and best practices of insurance and financial professionals today. On this show, our objective is to help you optimize your life, optimize your profession, and learn from other optimized advisors. I'm your host, Scott Heinela. We hope you enjoy the show. Welcome in, Andrew.
Thanks, Scott. Appreciate you having me.
Costa?
Costa. You got it.
All right, perfect. With RX3.
With RX3, down the road.
So you're new to the team.
New to the team. But
not new to them, correct?
Correct. Been with the strategy about 2.5 years.
Okay.
So quick background, we'll jump through it, and then we'll get into RX3. But started my career, actually, went to the Air Force Academy, military, in the Air Force for 5 years, then got out, went to business school, flipped on the finance track.
Where did you grow up?
Upstate New York.
You did, okay.
Nice and rural.
Okay.
But did that, then kind of got into the finance world, started banking with JP Morgan on their consumer retail team, did all those humble, fun years, associate, and then got tapped, move over around my VP years with Morgan Stanley, really covering e-commerce, that intersection of technology and consumer and how that all overlaps. And along the way, I got to meet one of the partners of RX3, Byron Roth, jumped over as his chief investment officer of his holding co, family office, a lot of different strategies there, one of which was RX3. And so what is RX3? It is a growth equity fund. We're on our second fund now. The idea is really bring influential athletes, celebrities, entertainers. They have unrivaled access to deal flow. Mm-hmm. Every founder wants Aaron Rodgers, one of the big names, on their cap table. A lot of them don't have a vehicle in front of that to do diligence, really dig into the companies, support them long term. So instead of doing one-off deals, Nate Raby, the other partner who you met, started RX3 about 5 years ago. So first fund was a little over 50 million, 19 portfolio companies, 4.5 exits so far, and really kind of proved out the thesis. So later stage growth investments, really partnering with some of the best minds, founders, culturally relevant brands, and other private equity partners to really drive outsized returns here. And so, proud to report we're on fund 2.
So, all right, let's unpack that.
We'll unpack that a little bit.
A little bit. So when you look at a growth equity portfolio fund, you think about a company like Roth.
Yep.
Roth Capital as an example. How do you nuance or niche each of those portfolios and those accounts? Because RX3, the point of this is RX3 we are focused. We have a unique niche and interest in the investments that we're going to make and the deals that we're going to close on. Like, how diverse do those get? Or is it simply the athlete's drive to you? Again, one mechanism, not all, but certainly they're a conduit to exercising information, exercising deals, and saying, is this something that fits the mold or not? Or
yeah, so I think a lot comes from our limited partners that happen to be different celebrities, pro athletes, different things like that. But I think what's important here is really picking your lane and what you're good at and what you can actually add value to as a PE fund. I think there's a lot of vanilla capital out there, but what we're really good at is not picking those moonshot, seed stage, 100x return or zero type assets. It's culturally relevant brands that have proven that product market fit. So we're coming in, kind of Series B or later. So these are companies that have a good profit engine building. They have multiple green shoots of where they're going, and you can really track, if XYZ goes right, a M&A offer or a public market exit, which is what we've seen.
Does that mean that an RX3 won't do a Series A? Or
we have done a Series A.
Okay.
I'd say the vernacular is changing quite a bit in this market.
We'll talk about that.
Exactly, yeah. But normally, we say trailing 10 million of revenue. It's moving up a little bit higher, and then a huge focus on profitability in this recent environment.
Why wouldn't you just stay where you were doing what you were doing?
Loved what I was doing. RX3 is growing as a platform, new fund, multiple LPs. This is what I always wanted to do, was be a consumer investor, love these brands, love the operating cadence, and just bringing them from, they've kind of proven out the 0 to 1, right? So it's really getting them from 1 to 5. And then once they hit that public market exit or that, great M&A event, we kind of unhitch our cart, right? Big acquirer comes out and buys them, but try to be supportive with the brand through their life cycle. And, that does start early on, right? Most of our investments we've known for a few years before it kind of hits that point where it's like an RX3 asset. Mm-hmm. So screening, definitely getting to know a lot of young brands, and then just figuring out categorically where can we truly add value with our LP base.
So let's talk a little bit about Fund One.
Fund One.
5 years ago?
5 years ago. So 19 portfolio companies, and I'd split it really into D2C and then consumer essentials. And I think as we're seeing in this current market environment, the consumer essentials, I'll pick out Mavis, pet food, different brands where you're not going to cut back, really just hitting the mark. Quarter after quarter, they have a really nice monetization engine. Some of the D2C brands that were relying on paid media, paid marketing, they're going through it right now. They're trying to figure out how can we reach consumers in the most efficient way when paid marketing just doesn't work as well as it used to. And so a lot of that is strategic partnerships, levering different P&Ls. Hey, can I do a partnership with your brand because we're talking to the same consumer? They're going to buy our products, but really trying to figure out what does marketing in a new world look like. Mm-hmm. And so the marketing teams are having to earn their salaries for sure.
But I think this is where some of when I say the brands of the athletes also add a valuable component in certain instances.
And so we never lead with that. We're a PE fund that happens to have LPs that have an outsized influence. And so what we really look to is when we bring a new brand on, who authentically relates to it, be it a water brand, you name it, and setting up that authentic relationship for them to lean in. We're not agents. We don't do endorsement deals, anything like that. And I think consumers are smart. They see the fact that, if Josh Allen, one of our QBs, really loves a brand and is using it quarter after quarter, it's not just 5 posts or something like that. They can authentically relate to it. The other piece to this, and for Fund 2, we brought on a lot of agencies that have micro influencers. So you have this kind of high-low strategy of big names, but then let's rely on the influencers that actually sell product and are professionals at selling product and can really engage their audiences. So I think that strategy now more than ever is needed.
So let's pivot a little bit and talk a little bit about interest rates.
Yeah.
So in 2018, Fed's fund rate was certainly off of 0. It was probably in the mid 2s, if memory serves me.
Yep. And then they unloaded the gun. No bullets left.
And then they unloaded the gun. What's interesting about that, as we look back over the last 5 years, is RX3 was born out of not a very good situation per se,
yep.
Or I would say some potential headwinds. Certainly not free capital, we had for a number of years, but that accelerated a number of opportunities, I'm sure, just across the industry at large.
Exactly. And so I think a lot of different brands, RX3 excluded, there are a lot of brands that got a little bit addicted to the free capital cycle. Raise your Series A, 4 quarters come back, raise your Series B. That capital is there. The valuations were screaming. Some of these outsized valuations we see, we kind of look at and we're scratching our heads. But now we're kind of seeing an environment, and I'd say, started with Russia, Ukraine, but is really starting to flow through the private markets of capital is tough to come by. There's a lot sitting on the sidelines, and the great companies will get funded. But where are they going to take that capital? How are they going to get it? Is really kind of the next founder question. Mm-hmm. And so what they've had to flip to is, how do I build a long-term, profitable, sustaining model, assuming that I just don't have this flywheel of capital coming in? And so I think that's whether right or wrong, it's something we've always looked for and been patient and disciplined on with all of our investments. And luckily they aren't, kind of those early seed stage investments that, that was the only way that they were going to scale. They've already proven that product market fit. And then that's when our strategy really helps. And we can lean into our brands, bring different folks, activate different things, do events, different series with our brands to really bridge that gap that, okay, paid media doesn't work. That's fine. We'll figure out another solution with some of our LPs. So it's, I think it's a healthy reset. A lot of founders are really reevaluating. Did I need that 40-person marketing stack just strictly looking at paid, or should I move to different avenues to really drive that revenue and profitability?
And so, just some basis information. I was crunching some gathering some charts, if you will.
All right.
So the Fed's fund rate in March was 0. The Fed today raised another 75 bips.
Yep.
They probably have one more. So we're sitting at a Fed fund rate at 3.75 to 4, somewhere in that range.
Yep. Go to 4.25.
We'll go to 4.25.
Yep.
Probably no
Easy.
problem.
Yep.
For how long? What will the impact be? Question mark. 10-year Treasury, which is predominantly where our product and our world lives, and in the world of annuities insurance, the 10-year Treasury, which it's interesting because a lot of people they correlate rising rates means directly that all rates rise together. They
That's
don't.
not the case.
I mean, to a point, all tides eventually
Inefficiency
rise.
should, yes.
Exactly. But 10-year Treasury, as an example, in 18, Fed's fund rate was maybe 2.5, 2 to 2.75, somewhere in that range, depending on what period of time. Well, Fed funds, the 10-year Treasury was half that at best.
Right.
A year ago, the 10-year Treasury was at 1.5. Today, it's at 4.10. Some very, very interesting returns year over year. So Amazon, and I just kind of hand selected a handful of household names.
Yep.
Down 42%. Peloton, down 90%. Coin, down 80%. NVIDIA, down 47%. Meta, I'm rounding off for everybody, 71%. Apple, actually positive, 1.7%. Interesting. Yep. And then just brought in indices. So S&P's down 16.71. The Dow is down 9.5, 9.53. And NASDAQ's down 30.68. So that's all public market data, right?
Yeah.
And information. One side of the coin. Where does the whole alternative space, private equity, growth equity funds come into play there as using and we talked a little bit before, just this broad alternative investment category.
Right. It is massive.
Massive.
You know, when you're talking alts, we're in one small corner of the sandbox with, late stage VC, PE, all sorts of different alts, right? I think what I'm seeing there is if you ran that 2 years ago, you'd be saying, okay, everything's up. Free capital's easy. I think what you need to do is take that long-term horizon view on the fund, 5-year investment cycle, 7 to 10-year fund life, and really figure out and moderate and pay multiples that you can come in, weather any of these storms that is going to happen. I think most folks, if I read kind of the inversion of the yield curve right now, right, they're factoring some sort of recession into 23. And, where we sit right now, like we talked about a little bit, I do think there is about a 6-month lag from where we're at in the public markets and really how that truly flows through to the private markets. But I think we're in like round 5 of a 12-round fight. This is going to be long. And one thing that I am positive about and optimistic about is consumer spending's hanging in the pocket, especially if you bifurcate the cohorts of high income, earners. They are paying that 8% inflation rate. They are going on that trip. They're going out to dinner. So they're hanging in the fight right now. But I do wonder, looking forward about another 6 months, does that start to gnaw at people and really start impacting their spending? And that to me is worrisome. And so my base case is kind of 2023 to see where this all kind of capitulates as it relates to the private markets. I think the public markets, we're starting to see a little bit of a rebound. I think we might have pulled the e-brake a little too hard on rates, but the Fed's got to do what the Fed's got to do.
Right.
So interesting setup for our second fund and how we look at investing right now, and just the $1 trillion of capital that's on the sideline in the private markets. There's a lot of money out there, and everybody likes to point at what's different this time, but there is money sitting on their hands right now, just trying to figure out this whole algorithm of when do I invest? And in the private markets, you're not really looking for that right time, that market capitulation point, that T-chart that you're looking at on your screen. It's really, can I find a great manager that can weather any of these storms, and a great founder, a great team with a product that's going to endure through my investment cycle? And so that's where we spend all of our time.
It's interesting. I think about a company like the Dollar Shave Club for Men is just an example. Company that didn't, to my knowledge, it didn't actually generate any real profit. It through social media marketing and incredible branding and video content and just creating a wonderful awareness in a subscription model, killed it. Yep. And for pure market share, was acquired at probably an incredible multiple. Wonderful.
$1 billion.
Yeah.
It was the
But it was top line revenue, right? That was the lens and probably market share at which that acquisition made sense.
And so if you unpack that a little bit, I look at that as one of the first openings of the floodgates into the consumer D2C realm. And this was a time when Silicon Valley money was looking at your cohort analysis, your LTV to CAC, all these things, and said, okay, with this retention, this subscription rate, we can underwrite this as if it was a B2B SaaS company.
Mm-hmm.
The findings is the world changes very quickly, and those SaaS metrics that you might be using to evaluate a consumer company don't normally pan out. And so you saw this with a lot of these D2C high flyers that came out, not to pick on like a Warby or an Allbirds, great businesses, great products, but they're consumer companies at the end of the day.
Mm-hmm.
And, there's no amount of, waterfall analysis that you can do to really predict exactly where the consumer is going to go, where they're going to spend their money. They're not contractual SaaS businesses. So you saw this mass influx kind of following that Dollar Shave Club deal into the space that's really kind of retreated and retrenched to say, I want to see EBITDA. I want to see pure profits. I want to see a business model that you don't need to grow 500% year over year. Give me a 30% growth rate and do it profitably. That's something I can underwrite.
And to add to that, you're seeing that, I think, in one of the reasons why I cited these returns of some of these hand-selected stocks, I think you're very much seeing that in terms of the market saying, we really want you now to focus on overhead expenses. Are you running fat and happy because you were leaning on simply free money supply, 0% interest rates? Well, that game is over. Amazon gets hit with a 10% correction in a day after already getting beaten down, which is a great company. But where's your profitability? Are you too overstaffed? Where can you cut corners? We got to trim away some of this fat that has been procured over the last 5 years.
So yeah, I think there was a lot of, hey, we'll just buy our way out of these issues that we have with the company where we could just get economies of scale and grow top line that much faster. So any of these bloated line items, they'll look better because the bloat will come down as a percentage of sales. All of a sudden when, you can't really fund a marketing ROAS in some of these companies or build outs of new shops, new stores that quickly with new capital, then all of a sudden it starts looking even more bloated. So then that's when the valuations in the public markets come down. So I think you're seeing a healthy correction with a lot of these businesses. Mm-hmm. Some of them taking a little bit too far, in my opinion, with some of these bellwethers. But right. I think, as we talked about, indiscriminate selling across the board, everybody just is beating up on every company. It's not, unless you're energy, it's sector agnostic right now.
So within RX3, the sweet spot in the size of partnerships or investments that you're looking to make, what are some of those metrics?
Yeah, so start with great management teams, category defining brands. With that, we want to see at least 10 million of trailing revenue, and that's moving up a little bit, and then real profitability. What I mean by that is not an adjusted EBITDA number. It is truly, 3 to 5 million of EBITDA coming in the door and a real path to scaling that profitability. In this environment that moves towards consumer essentials, things that you have to buy, be it tires, be it different pieces like that, or consumer tech brands that have a digital element to them where there could be some breakaway growth. It's not just a linear, I'm selling water bottles or something like that. It does truly have a following, a consumer base that will add on and attach to it and build an outsized return. So that's generally our thesis going into it. But going back to everything we just talked about, comes down to the management team at the end of the day. We're not investing for 2023 and we're not investing even 2024. Nobody knows what's going to happen out there. Global pandemic, global recession, who knows? It is somebody that can be the gladiator in the pit and just continue just to roll through these changes.
And so I think through this environment, the markets is going to sweat out. It will force out weak leadership. Yep. It will, on the flip side, promote, and the cream of quality talent will rise to the top. Why I say that, or what leads me to my question, is then when you look at Growth Fund 1, polarizingly different market.
Correct.
Than where you sit today. How does it shape, if at all, the difference in how you focus on deals? Because let's say I could run. It was much easier to run a firm and grow a firm when interest rates are at zero. It becomes significantly more challenging when capital is expensive.
Right. And so, I think it comes back to risk mitigation, and really the strategy has not changed from our investment thesis. It is finding folks that are going to pull from every tool in their quiver, right? To really just, how can I take this great product or solution that I brought to the market? Others will fall away, which is actually a great thing for some of the brands. But how can I weather these storms and risk mitigate in the best way? And, at the end of the day, it is all about growth and kind of that exit potential as you sit there as a fund manager, but build for the long term. And I think this reset and just kind of cold bath to most of these founders has been the most positive thing, because now they have a business that they're not up all night stressing about where's that next round going to come from? Where's that capital? It is, I have a great business. It is scaling. It might be growing a little bit slower than it was, but that's great. I'm not worried at night about it. And so that thesis, permeated Fund 1, and it continues to be how we invest in Fund 2. And so
the story doesn't change.
Story doesn't change. Investment thesis doesn't change.
The underlying environment we operate in has dramatically shifted.
And it's going to dramatically shift in the next 5 years,
which I love.
And so I think that is critical. And just coming back to discipline as a fund manager, you can't get too exuberant into whatever's going on or too high on different things. I think, we don't know what 24, 25 is going to look like.
So 3, 4, 5 years ago, I would imagine deals were everywhere. Yeah. Was the challenge sifting through to find the quality management, the quality companies, the ones that are profitable, that hit your thesis right now?
And not overpay for them.
And yeah. So what were you seeing? Not then, like within the let's say 2020, 2021, yep. Incredible multiples.
Incredible.
Hard to value.
Best to take warrants alongside those deals, so that if we perform as a fund and bring all the value add that we say we're going to bring, we can kind of buy down our multiple over time, is kind of how we looked at some of those valuation setups that just we scratched our head on. And so using different assets like that within a term sheet to be helpful and value aligned with the founders, getting those warrants was very important in that time.
But Growth Fund 1 has done very well.
Very well, yeah. Outperformed the market. Great to have some exits. We have 2 more that we're just about ready to go this year. So whenever the IPO
in Growth Fund 2?
1.
Oh, in 1. Okay, okay. Where is the current state of Growth Fund 2? Because there's been 1 capital call.
1 investment so far.
And can we talk about that one?
Of course, I'd love to. Okay. So Growth Fund 2.
I was excited about the product.
Yeah. So Growth Fund 2 is $120 million on the cover. Happy to say we've raised more than that. We'll close it off at the end of the year. Wherever we sit, we have a hard cap at 200 on that one. Taxa Outdoor was our first investment. This is, they don't like the term RV, but an over-engineered habitat for the millennial outdoor consumer that, through COVID just found this new passion in life, but couldn't afford that $500,000 over-the-road RV. They needed something more compact that they could pull with their car, bring it out. Every inch.
Who found the deal?
So this one actually came through L. Catterton.
It did, okay.
So large consumer fund based out of Greenwich. We bought that company outright with them at a very favorable multiple. Have been adding to the team, really building it out as a challenger brand within this somewhat slow-moving category of just large behemoth.
It's definitely not an RV. So for listeners, I would suggest looking it up. Taxa Outdoors is the domain. They're on social media. They're doing a really good job, actually, with the branding and that marketing initiative.
Right.
I'm impressed with it.
You don't have to be taking the kids on a camping trip. We did a tailgate series with them where you can go put a TV on this thing, cook on it. It's a phenomenal tool just to bring with you when you need that kitchen. You need all these assets around, but you don't want to bring a whole huge U-Haul trailer of all these different things. So
it's awesome because it's a habit. The appropriate word.
It's a habitat.
It is a habitat, and it caters definitely to like millennials and Gen Z, where you could even tow it with my Tesla if I wanted to, my e-vehicle.
Got a lot of pictures of those. Yeah,
exactly.
So home run company, love the team. Founded by a NASA engineer who just was frustrated with what he was seeing in the market, so he just went and built it himself out of Houston. And his DNA really permeates through that brand. So
how are they doing?
Very well.
Because you hear a lot of things in the news about RVs have come to a standstill.
Category
but again,
challenge.
it's not it is an interesting category, but there's where, as is talking about its niche, its lane in the habitat environment, I would argue a lot different than the RV market.
So it is what the consumer wants. Now, they don't want that traditional, I'm going to walk into a huge dealer lot and I don't know what I'm looking at. It's a high pressure situation. They want to peruse online to go find it. And they want to make that decision personal. Not to say you can't go get it
just
on a
like
lot.
they bought their Tesla.
Exactly. It's functional, delivered right to you. So I think the setup is much more geared towards millennial consumers that are kind of in this next stage of life, might be having a couple kids that they want to bring out, go camping. Great way to access the outdoors. And some of the brand collaborations we're doing with them have been pretty interesting, and we'll continue to do that to support it and just build an ecosystem around outdoor living. So great
Are
investment.
there more outdoor living deals that you guys are looking at?
We look at quite a few a week.
You do.
Love kind of the experiential side of it. So, what does an Airbnb for outdoor experiences look like? I don't want to go to the KOA campground anymore with sit next to 200 people. I want to go to a vineyard. I want to go to here. How can we build kind of that experience into the taxi experience if we want to? So, looking at a lot of different things there. That's a categorical trend that, headwinds certainly from gas prices, return to work for sure, but it's something we saw out of COVID that is really staying with folks that experienced it for the first time. And so,
and the business is delivering.
Wow. Building out new facilities, just scaling, and relatively small compared to a Winnebago or Thor,
of course,
like that. But
that's the point.
Exactly. Yeah. So out of Houston, if you're ever in there, check them out. Great little company, great team. And good to partner with an L. Catterton on this, where we both bring different skill sets to the table.
All right, so let's talk a little bit about deal flow.
Yeah. Anybody
who
in the
dips
market,
their toe in the water? I mean, you're seeing some deals that are released in the press, and obviously I know there's a ton that are underneath the surface, but you're seeing some very unique deals. I think Adobe made some significant acquisition recently.
Absolutely.
There was another. For your deal flow, I would imagine deal flow is significantly reduced. Is that true?
In the growth equity space, I'd say that's true. So folks in the market generally need to be in the market. They have a cash runway that is coming to a cliff, and they're going to have to make some hard decisions if they don't raise capital. They know all the valuation paradigms and where everything is at, and they're in the market with a great deal right now. That's not our firm. There are a lot of different distressed turnaround investors that are having the best days of their life right now. Everything's on sale. I think, but out of this, you're also seeing a lot of folks utilizing what we learned through the pandemic and with all our new tools and technology to activate consumers in a way that, I don't think has ever been done before. So I look at, more concierge, personalized healthcare. Instead of just selling VMS, how can I make this perfect for you, Scott? And I can do that all through telehealth. I can do that all through different blood tests. Different barriers have been broken down that I think people are taking advantage of coming out of the pandemic that are interesting. That said, never like to say we're being more patient, but being very patient right now as we kind of see, this macro environment and what that's going to mean for all of our companies.
So do we wait for certain elements or metrics within the space where interest rates need to level off? You're seeing valuations obviously continue to reprice. Have we hit some kind of a capitulation or leveling off of valuations and where we sit today that we're okay, now we're ready to look at really deploying, or are we still just kind of in analysis mode?
Feels a little bit more the latter. I think consumer spending is where I spend a lot of time, and where can I separate folks from their wallet into what brands, and what is really that point where somebody says, yes, I am going to take wallet out, I'm going to pay on this, and how are brands really accessing a community and building that around them? I think from the basic sides, ubiquitous things, Amazon's got that taken care of, right? How can I really build a consumer brand in this new environment? And that's really where I'm spending time versus, I do think interest rates are going to be tough. I do think, inflation, we're going to start lapping this year. So, it will come down, just by a function of math over time. But, I do think.
Well, the Fed is handling that. The question will become, what is the repercussion through mortgage, through consumer spending as we head into 2023? I mean, it's all but a foregone. I mean, BNY increased their likelihood of recession to 70-some%. So, I mean, and you can go on and on and on.
Yeah, we're going to go through it. Tight
We
labor
will have a
market, though.
recession.
There are a couple things here that tell me that okay, the consumer's hanging in the pocket. And how long is that going to happen? Well, they're spending money somewhere, right? And what are the new brands that are finding new ways, unique ways to access that community? That's what I'm most interested in. So, seeing a lot of cool new concepts come up that don't look like the last 5 competitors in their business. How can we take a business solution and just flip it on its head and really build a new community here? Because the consumer is so smart nowadays. They price compare, value compare like nothing I've ever seen because they have every engine, everything in their toolkit to do so.
On one little device.
One device. And so to me, that is a category trend that won't change. And so you really got to deliver value and something that tells me I need to be a part of this community versus whatever you were showing me in the past. And so that's what gets me excited out of this environment. But I think base case going back is probably summer of 2023 where we see kind of the Fed impacts, everything flow through, even the housing crisis. If I look at, MBS rates rising like crazy, a lot of my friends are in that first time home buying category and, they just got priced out of the market. And so, yes, there will be a correction there. What does this all mean? It means got to go back to those founders that have been there, weathered storms. Maybe they had a company that they sold and exited through that can just pivot through all these different environments that we're seeing.
Do you see a lot of businesses not being able to get through this?
Unfortunately, yeah. It is the worst day. You have friends, families that, got caught on a treadmill of capital raising and just didn't get that next round, didn't get that next piece that fell. And, maybe their consumers are softening a little bit if they were a high discretionary spend asset. And unfortunately seeing a lot of companies kind of go through that right now.
With that said, though, the flip side of this is those that are talented, right? The talent will rise to the top. Some of the greatest companies are born through times like these and thereby opportunities.
Fully aligned on that. Yeah. It's tough, this reckoning, and it's hard to sit there on the sidelines and just watch some of this carnage go down. But
money supply and the markets just got so frothy.
And nobody was complaining. And, as the S&P was up 22% over the past 2021, and the Fed interest rates were nothing, and capital was coming in, and, everybody thought that was great. Probably that was the time for the Fed to sit there and say, well, we're a little overheated right now. Let's see what we can do. So be interesting. I think, no projections past 2023 right now. It is, an environment. I go back to the boxing round 5 of a 12-round fight. We'll see what happens.
So off of your day job here, what stokes your professional fire? What is your personal interest? Tell me a little bit about you.
So big outdoors guy. I have a broken rib right now. I was out dirt bike riding with a couple of buddies, slipped off a bike. Probably goes back to the military days. But newly a family guy. I have a 7-month-old. She's beautiful. Phenomenal wife at home. So
you were saying she's sleeping through the night.
So I'm sleeping, which is phenomenal. But yeah, that to
Did she not sleep very well the first 90 days? Because my son did not sleep an eye. I can remember.
It's the every 2-hour thing, and it just, you black it out, I think. But that drains on you for sure. But then I think your threshold just comes up because your sunk cost is now not spending time with your daughter, right? And so, to me, that's been a whole new valuation paradigm, if you will, of, do I want to be here or there? But no, I just, moved down to Orange County about a year ago and loving the community, on a plane all the time, as you can imagine, seeing new companies, meeting with LPs, meeting with different funds.
That's what I was going to ask you. What does your weekly schedule look like?
Yeah. So luckily, a lot going on in Southern California more broadly. Within a 2-hour drive, you can see a lot of impressive fund managers, companies, new ideas, new symposiums. Not bad being here and going surfing with a couple founders. That said, love what's going on in Utah right now. A lot of innovation happening in Texas, Miami. So we are on a plane all the time.
That is interesting you said that, because I was at the opening game for the Jazz.
Yep.
And as I'm sitting there, I'm observing all of the advertising going on in the arena. Yeah. And it's one company after another company that I've never heard of.
You just drive.
There's at least a half a dozen that are advertising within just the arena alone of this company, .com this, .com that. Not that they're tech companies, but that's their domain. And I'm like, what is going on here?
Just the young companies that are a lot of them are second-time founders moving to Utah. Phenomenal talent pool out there, and
why do you think that is?
It's a great
geography,
space, right? I love
the
living by the
topography?
mountains.
Yeah.
Phenomenal community out there. So to me, it's just in these innovation. It's tough in LA. LA is disparate. I think Silicon Valley is a little bit different because it's everyone's trafficking in the same space.
Right.
I think what you get in Salt Lake is you get that proximity to the mountains, phenomenal tech talent, and a lot of folks that have built their first companies and they're just leveling up there. So it's I actually spent a lot of flights back and forth to Salt Lake over the past year.
That's easy though.
Yeah.
That's a commuter flight.
60
man.
minutes.
Yeah.
Miami's interesting right now. A lot of
Do you ski or snowboard?
big skier.
Okay.
So, didn't really get into kind of the Web3 or crypto or any of those investment theses. Yeah, probably better off. But,
Right.
A lot of the innovation, just tools and utilities that were coming out of Miami in that last exuberance boom were very interesting to see how people would solve new problems with these solutions like that. So we have an office out in Miami. That's where Brian Roth lives.
Okay.
And so have a lot of connectivity with different folks there.
Okay.
It's been interesting. But yeah, that's me.
All right. Interesting. So in closing, if we can wrap up a little bit with, can individuals reach out to?
Absolutely.
Because we work with many advisors. Their advisors probably have affluent clients, accredited investors. That's what you would be potentially.
I'd love to tell them a little bit more about the fund. It's tough email. It's Andrew@RX3growthpartners.com.
There you go.
Anytime, reach out. Great website out there. We're also on that. Find us. Love meeting new folks, new ideas. Send them.
Does RX3 have any interest in, and maybe whether we include this or not, I'm just curious, in the athletic apparel space, or is no?
Apparel's difficult.
It is. It's very scary for me. And I'm just consumer, but it's like.
If I look at all my, mostly of my investment banking deals were in fashion e-commerce, and those are the toughest deals to get done. And so the margin profile, where does it all end up and go? Like, we're all wearing clothes, right? But, I think it's an easy one for us to activate. We are in Mack Weldon, which is a little bit more tailored, a little bit more, I'll call it work leisure. But I do think I love the category as a consumer, love a lot of the founders. It's just a little bit difficult of a parallel unless it's going to a large brand aggregator that has multiple, where do these companies go over time?
Well, as a consumer, you talk about social media marketing and all of that. It's so inundated. And so what that tells me is, how much less return am I getting on the marketing that I am doing? So in other words, I'm having to deploy significantly more capital through the content creation and advertising expense in exchange for what?
My brand's competing against you, her brand, like everybody is fighting for the same consumer.
And how much market share or how much volume do I need to gain within that space if I'm direct to consumer for it to move the needle?
Right. It's crazy. And
I don't know. That's a question.
So to me, like, unless you're kind of eclipsing on that kind of 50 million top line, you're in a hand-to-hand combat, just trying to get those eyeballs onto your brand.
Wow.
And really proving, what do I stand for? Like, most people have fit pretty well figured out. You put something on, it's a large, fits pretty well. But can I innovate different, solutions with this material? Can I do these different things? And, some brands have done phenomenal at that. Some have gotten a little complacent.
Right.
And so, as I look at it in the long term, I think everybody's got to buy clothes, right? It's a non-negotiable. I'd even maybe put it in that consumer essentials bucket. But to get to that consumer essentials bucket, you got to build a massive business and just have that flywheel and just repeat customer that loves you. So apparel, difficult, but personally, it's my favorite category.
Is it?
Yeah.
Okay. So it's not a no, but it's a challenging space.
It's not a no, but there's a lot of questions.
Yeah.
Yeah.
It's like, who's the next Lulu or the next Viore?
Viore, yeah.
Yeah.
Phenomenal business, and I think differentiated product, differentiated.
But how many of those do you go through before you get to that?
See, about 100 a year. So,
I mean, that is.
Yeah. But, it doesn't mean you can't build a great small business versus a startup that really needs growth capital, right? I think there are so many small businesses out there that make great apparel, and they don't need to be on this flywheel of capital raising because they're profitable.
Right.
And there's nothing wrong with paying yourself a dividend.
That's the key. Good leadership, talented team, profitability.
Exactly. It's RX3.
Bingo. Cheers. Thank you for coming out.
Yeah, I appreciate it, Scott.
Until next time. It was great to meet you.
You as well. Thank you.
Thank you for tuning in to today's episode. Please subscribe, like, share, leave a comment or review. Be sure to check us out on social media at Optimized Advisor Podcast. Till next time.